Well, good morning, everyone. We'll go ahead and get started now. I'm Greg Frick, partner at HFO Investment Real Estate, and I'm excited to welcome you to another roundtable event. This marks our 20th year of hosting these educational events for multifamily owners. Man, I feel old when I say that. I hope the insights today will help you guide on your real estate decisions in the upcoming year. But before we get started, I'd like to introduce a couple of our event sponsors. The first one is Pacific Exteriors Northwest and Gantry, Inc. Pacific Exteriors Northwest is a trusted local contractor specializing in the exterior envelope and waterproofing of single-family homes, condominiums, commercial buildings, and my personal favorite, multifamily properties. Their expertise in siding, windows, roofing, and decking, along with over 30 years of delivering exceptional quality and service, Pacific Exteriors Northwest proudly serves owners throughout the Pacific Northwest. We have a few people here from the firm, and we ask that they stand up to be recognized, and thank you. Right back there. Our other sponsor today is Gantry, Inc., the nation's largest independent mortgage banking firm with offices in key markets across the country. They've been serving clients since 1991 and finance all types of commercial properties. Again, we have a few people from Gantry as well. Stand up to be recognized, and we're going to have somebody from Gantry on our panel as well. There's Charlie right there. Thank you. A couple things before we get started. If you could please set your cell phones to vibrate, would be much appreciated. And the other thing is your feedback is very important when we put on these events. If you can take a moment to scan the QR code in your booklet. There's also a survey form, I believe, on the tables. You could use that as well. That helps us plan various events or interviews and things like that throughout the year, so it's very vital information, and appreciate you taking the time to do that. So for this audience, Dr. John Mitchell doesn't need any introduction, but I'm going to go ahead and provide one anyway. Dr. Mitchell is owner of M&H Economic Consultants, a former chief economist of U.S. Bancorp, and a professor at Boise State University. He's authored numerous publications and served on both the Oregon and Washington Councils of Economic Advisors. We could probably use you back there again, John. For the past 16 years, his presentations at our events have been annual favorites. So please join me in welcoming Dr. John Mitchell.
Thanks, Greg. It's very nice to be here. The thing about if you accept an HFO gig, you never know what's going to happen. We were meeting at this event when they were rioting in Washington, D.C. on January 6th. Last year, we had this winter Armageddon that dramatically reduced the attendance. And then now we get a Gaza ceasefire. I mean, you never know what's going to happen. Well, what an amazing time. Now, the title I put on this, A Non-Standard Transition in a Non-Standard Upturn. We're in the middle of year 5 of this particular upturn. High levels of employment, but some softening in the labor market. Inflation, we had some decent inflation numbers yesterday on the core, but inflation is still above target. It's well below where it was in June of 2022. And the Fed, of course, is cutting rates, but what's happening to mortgage rates? Mortgage rates are going up. That's not the standard pattern, but we'll talk more about that later. 2 years of double-digit equity gains. The S&P 500. Phenomenal increases in wealth associated with that. Then on a personal note, Blue Bloods is gone. All right, home prices continuing to rise while permits decline. Next week, none of us know what's going to happen next week from a policy perspective. We have lots of rhetoric, but we don't know what it's going to be. Well, you got to spend a little time talking about GDP. The key point that I want to make, we started up in the spring of 2020, okay? Most recent quarter, third quarter of 2024. And, we were growing at a 3.1% annual rate. But the key thing is, look where the strength was. Consumption. Consumption accounted for 2.48 percentage points of that 3.1. Housing continued to go down, okay? Inventories bounce around, and we've got rising defense commitments. If you look at the net worth, we have rising real after-tax income. We've had upward revisions to the income data and savings. Q3 net worth, according to the Federal Reserve, for households and nonprofits, up $4.8 trillion. It was up again, and they're up also in the second quarter and the first quarter. So balance sheets for consumers are pretty strong. From an employment perspective, okay, 55 months up and 1 down since May of 2020. December, 256,000 net job gain. Unemployment stays hanging at 4.1%. The participation rate, that's the fraction of the adult population in the labor force. It's down from what it was before the pandemic. But remember, we've got this aging population, baby boomers retiring. We had a new beige book yesterday, but it really doesn't change anything. Continued growth, some slight moderation in inflation. And then one of the things I think is fascinating is 31 states have unemployment of 4% or less. The lowest is South Dakota at 1.9. Okay. But I think it's important to understand that labor markets are tight across much of the country. So we continue to grow. From an inflation standpoint, you all experienced it. We had a number of things come together, whether we talk about COVID, the war, the stimulus, supply chain interruptions, changes in the structure of demand that pushed the price level up dramatically. The peak was in mid-2022, and it's come down, okay? It's come down, but if you look at on that left-hand graph, it's sort of leveled out. November, you had 2.7%. Now, the December numbers came out yesterday, was 2.9, and the core was at 3.2%. The thing you have to remember is the Fed's target is the 2, okay? We're not there. We are above target. From a policy standpoint, and I think this is really important to understand what's going on with interest rates and that sort of thing. If you look at federal spending, you look at that graph and you see that huge jump at the time of the pandemic. You think about it. You had the CARES Act, then the Supplemental Appropriations Act the following December, okay. The American Rescue Plan, the Infrastructure Bill, the CHIPS Act, the Inflation Reduction Act. You saw this surge in spending. It's come back down, but notice it's not come back down to the trend before. It's at a higher level. We saw the Fed react with 11 increases in the federal funds rate. You see that on the left-hand side. They took the rate to 0 in March, or 0 to 0.25 in March of 2020, and then began to raise it in 2022. Now it started down slightly. But, there are some in this audience who can remember the Volcker experience, okay, in the early 1980s. Well, this is not quite the same, but this was a rapid run-up to deal with the inflation issue. Now, the Fed is going to meet in 2 weeks, okay? let's think about that decision-making environment. What did they do in December? They raised their inflation outlook and they raised their growth forecast. They put out here's what the members of the Board of Governors and the Reserve Bank presidents think. Okay. In December, they said the risks were balanced between weakness in employment and inflation. The outlook was uncertain. They raised their expectations of interest rates. Before, they were talking about 4 cuts, okay? Now, the latest one, they were 2. They expressed concern. I mean, think about it from a Fed perspective. You have potential policy not dealing with the deficits, the prospects for higher tariffs, price shocks, reduced labor supply with deportations and that sort of thing. We don't know what's going to happen. We don't know the details. Last week, inflationary expectations from the New York Fed in their survey rose. Okay. What's going to push long rates down? I'm sure you're concerned about that. Lower inflation would help. Deficit reduction would help. A recession would help push down long rates, but that's probably not the alternative you want. So we've had this interesting situation of the Fed cutting and long-term rates rising. Well, it'll be interesting to watch their decision at the meeting in a couple of weeks. Now, amidst this tightening, okay, we've seen building permits decline through November. Nationally, they were down about 2.1%. We've seen a plunge in existing home sales. The Case-Shiller Index, the most recent one through October, annual gains 3.6%. As you know, they track the same houses over time, and it's not just stuff financed by Fannie and Freddie. Okay, new all-time high in prices. Seattle was the 20-city index they use. Seattle was at 4.89. Portland was at 1.39. Federal Housing Finance Agency. Okay, their third quarter purchase only 4.3%. So we've got rising home prices. And then it shows up on the right-hand graph, but 55% of mortgages are less than 4%. You want to race out and sell, I'll get you a new mortgage at 7%. No, people aren't. There's a lock-in effect of that. We've got this legacy of low mortgage rates that are going to be out there for a long time. If we look at job growth, okay, now we're focused on the Northwest. I love this thing from Job Growth Update out of Arizona State University using the BLS data. All 50 states are rising. All 50. Oregon at 32nd. Washington is 33rd. Okay. South Dakota's at the bottom. They've also got a 1.9% unemployment rate. It's going to be hard to grow. Okay. But it's not an outlook. It's not a graph that's consistent with an impending downturn when you see this kind of strength. Now, let's think about Oregon and Washington, who's the HFO's focus. Those are not the same graph, but they look the same. You know, and you could do this for almost any place. You see the plummet in employment in the spring of 2020 with the lockdowns, the closures, that sort of thing, then the rebound, okay? So Oregon and Washington back up above pre-recession levels of employment, okay? And again, they do this in different parts of the country. Almost everybody's graph looks like that. Now, I've never tried this before. If we look at Oregon, what I wanted to do, on the left-hand side, you can see job growth year over year by the various metropolitan areas, Albany, Bend, so forth. And, with the exception of Medford, okay, they're all up, okay, Medford and Corvallis. Then you look at Portland, up 0.7%. The next column is from the Atlanta Federal Reserve. They have the ability of a median family to buy the median house, but in terms of the payments, they include the mortgage, and they include property taxes, and they include insurance. The target is for that number to be 30%. Look at Albany. It's going to take over 50% of the income of the median family to buy the median house. Bend, Corvallis, Eugene. The thing is, all those numbers are above 30. That ought to be great news to this group, okay? People can't, there's a major housing affordability issue. And then the next is permits. Permits through November, which is the most recent from the Census Bureau. And look what's happening. Okay, Albany, Bend down, Corvallis down. Eugene was up, but everybody's down. Okay. On the far right is the Federal Housing Finance Agency House Price Index for the year to the third quarter. You can see Albany up 3.7. These are the same houses over time with the mortgages purchased by Fannie and Freddie. DIQ means down in quarter, okay? Like Bend, house prices were down in the third quarter, but on a year-over-year basis, they were up 1.67. Corvallis is sort of interesting. Big decline in building permits, 8% increase in prices. So you see that the situation, we've got weakness in construction, okay? Continued increases in prices. Here's Washington, okay? Same approach. There's the job growth. Seattle up 0.7%, Tacoma up 1.4. There's the median income stuff. Look at the affordability. In Bellingham, it would take 71% of the income of the median family or household to buy the median house. Nobody's close to affordable. Okay. Now, the reason Tacoma's not there is in the data the Atlanta Fed puts Seattle, Tacoma, and Bellevue together. Okay. Permits. Look at the permits. Down in Bremerton, Longview up, Olympia, Seattle essentially flat. There's the Federal Housing Finance Agency data. You see the pattern. Continued increases, but many of them were down in the quarter. Okay, again, sort of in a sense, good news for people in this room. Now, this is sort of interesting stuff, I think. If you look at the population data, looking at 22, 23, and 24, you look at Oregon. In the green on the left bar is change in the total population. Oregon, 2022, 2023, down, according to the Census Bureau. Population was going down. Obviously a matter of concern. If you look at the details, the dark green bar is natural population growth. Look, Oregon, down, down, down. That's aging population and COVID and stuff impacted that. So migration becomes critical. The yellow is international migration. You can see Oregon positive in 22, positive 23, positive 24. The orange is net domestic migration. Notice, all three of them are negative, okay? Now, diminishing, and you can quibble about numbers, but clearly it's not the strong in-migration domestically that we had seen in earlier times, You look at Washington, okay? Washington, population rose in 2022, 23, 24. You had natural increase, international migration, okay? And Washington had 2 years of domestic out-migration, and then an uptick in 2024. Oregon, 0.4% last year. Washington, 1.3. The national number was right about 1%. So the demographics have weakened compared to what many in this room were accustomed to over the longer time period. Some of it's COVID related, but we'll have to see what happens as we move ahead. It's an uncertain path, okay? 2022, output up 2.5%, 2.9%, 23, probably about 2.8. We don't have final data yet for 24. The coming year, probably in the 2 to 2.5% range. But lots of uncertainty. CPI inflation, it's come down. 3 to 3.2 in 24, 2.2 to 2.5 in 25. Federal funds rate, the Fed, again, has signaled a slower rate of decline in the federal funds rate. It's going to depend on growth. It's going to depend on what goes on from an inflation perspective. You look at the outlooks for Oregon and Washington, hey, if you look at Washington, you look at a variety of outlooks for the state, 1 to 1.5% in 2024 and 2025. Oregon job growth was particularly weak in 24. You remember, of course, some of the largest Oregon employers have had significant reductions in staff, and moving up to the 1% vicinity in 2025. Okay. Now, it's a new environment. Okay. Significant change in environment. Some of you remembered Donald Rumsfeld. Okay. He was Secretary of Defense during Gulf War, and he had these great phrases. There are known unknowns. Okay. And that's where we are. We think we know that there's going to be policy changes next week, but we don't know what they're going to be. And then turning VLCCs. VLCCs are very large cruise boats, okay, for hauling oil and that sort of thing. Now, you don't change those on a dime. If you turn right, it's going to take a while to turn right or turn left. It's going to be difficult to have sudden impacts on an economy like the U.S. Let's see. We can be pretty sure the regulatory wave is going to subside. The SEC, FTC, EPA, Consumer Finance Protection Bureau, there's going to be different people put in charge. Gensler's gone, Kahn's gone. So we'll see what happens there. But it's likely to be a very different regulatory environment. Spending and taxes, and the deficit. I like to think there's been a deafening silence about the deficit. okay? It's a big deal to people in this room because of the impact on capital markets and interest rates. We've got the Tax Cut and Jobs Act that expires this year. It's going to have to be, it'll be replaced by something. Maybe it'll be extended. We don't know. And then we've got the DOGE, the Department of Government Efficiency, with Elon Musk, and we'll see what happens there. But that issue is out there. Federal Reserve policy. What are they going to do? Okay. 4 cuts to 2, the latest outlook. They're predicting higher inflation, higher growth. They have concerns about tariffs. They'll be put in place, labor supply that could impact price pressures. And remember, their objective is getting to that 2%. You think about tariffs. The president had a lot of power there. The world is worried. How far will it go? It's not the world, excuse me, that you and I grew up in. You think about the Northwest and the international exposure. Who's the nation's largest exporter? Boeing, okay? You think about the ag sector in the Northwest, heavily oriented to international markets. Those of you from Oregon can remember Vicatia, traveling the world, trying to get foreign investment and stuff in the state and develop markets. How are other nations going to respond? What's going to be the retaliation? You put tariffs on, Canada. What's going to be the impact on wood prices? That sort of thing. Building costs. They're vulnerable to trade wars. The drive to electrify, decarbonize, likely will diminish. What portions of the Inflation Reduction Act, the Infrastructure Bill, and the CHIPS Bill will survive? I noted this morning there was another grant on the CHIPS bill for a firm in Beaverton. And of course, Intel's participated in that, as well as a firm down in Corvallis. What portions of that are going to survive? Okay. And then there's the question about government allocation of resources. We are being challenged by a crink alliance. I like that word, it's easy to remember. China, Russia, Iran, and North Korea. Okay? They're challenging us. Okay? That's an alliance that is working to offset U.S. power. Massive deportation. 84% of U.S. population growth last year was net immigration. International immigration, 84%. Okay. What's the impact on wages if you were to sort of end that, deport people, building costs? The 3 big industries where you have undocumented workers: construction, agriculture, and leisure and hospitality. Okay, and we don't know what is going to happen there. I think we can be sure that the excitement is going to continue. And just like they said on the airplane yesterday, please remain seated with your belts fastened. Now, I usually sort of take my outlook at this time of the year and put it in terms of a poem, and I will do that now. 23 saw faster growth, lower inflation, and labor markets robust, defying expectations of a looming bust. Expectations rose that the Fed would cut rates as 24 unrolled. Stubborn inflation and labor market strength put those hopes on hold. Late spring saw the inflation rate moderate once more. The disappointing July employment number shook markets to the core. Japan raised rates, U.S. fears rose, and global markets wobbled for a bit. Jackson Hole teed up a September rate cut. Would it be a market hit? 50 basis points was the move. November and December each brought 25 more. But stubborn inflation and ongoing strength did hopes that 4 more would soon be in store. Wages, stocks, and home price gains fueled consumers who spent. Housing awaits affordability gains for the next generation to do more than rent. Growth continues with labor markets still strong, performance for which other nations yearn. Long rates have risen with deficit inattention, growth, and inflation concern. The election brought 45 back as 47 for a red sweep in our quadrennial dance. Pundits try to dissect the whys and the impacts of the new policy stance. Tariffs, deportation, walls, taxation, and regulation are all in play. Kiev, Moscow, Tehran, Brussels, Beijing, and Greenland all wonder or worry about this new day. From Kursk to Gaza, the Red Sea, and on to the Spratlys, we're challenged by authoritarians in a 30s replay who are striving for ascendance. Whether we rise to the threats with our allies in tow will be known by our descendants. 25 looks like another up year, fueled by consumers and investment and more defense post the 24 race. New people and policies will take time to form and be imposed, but the world will be a different place. Thank you for your attention.
Thank you, Thank you, John. We will have a video of this out next week or the week after, and also it's kind of summary of the slide. So I saw people trying to take some of the notes, but we can get some of that information to you. I also wanted to talk about, this is our 25th year anniversary. Behind us is a timeline of HFO. And I want to kind of give a quick shout out on that. Since our founding in 1999 in October, we've been fortunate enough to work with a lot of clients like yourself. We've grown from a small office of 3 brokers and 1 employee to the largest multifamily firm in the Pacific Northwest with a team of over 20. Thank you. Well, we couldn't do it without you, with all you people. From our first HFO closing, which was a restaurant and in a converted gas station on 19th and Belmont, to the Powell Valley Farms, a 230-unit complex that just closed yesterday. It's been quite a ride. From 3 original partners to now 5. The O now stands for others in HFO. 3 logos and color changes. We clearly must like marketing departments. 4 different office locations, and believe it or not, we're still in Portland. From Y2K, 9/11, Portland being the it place, Portlandia, the Great Recession, Washington Mutual becoming Chase, First Republic becoming Chase, strong rent growth, really low interest rates, to Chloe U. Daly and statewide rent caps, Vancouver waterfront development, COVID, and ranked choice voting for 12 city council people, which I still don't understand how they got elected. We've been through quite a journey from Tacoma, Medford, Spokane, Bend to the coast, and all parts in between. Over $6 million in transactions and over 40,000 units. So I want to thank you again. We would not be able to do it without our team, but really thank you clients as well for coming in and supporting us. By placing your trust in HFO, your choice has been instrumental in our growth and supporting countless others within the community. With your support, we've established a program focused on giving back through volunteering and contributions to numerous charities. And together we've given over $500,000 through the years. So thank you. You are the most important reason why we're celebrating our 25 years of success. So again, thank you very much. The HFO team will be back at the tables. There's some desserts back there. We'll take a 5-minute break before we come back and have the panel in the Q&A. So thank you again, and we'll be starting in about 5 minutes. So for a quick kind of update, we'll hear, John alluded to a lot of it in terms of housing permits and things like that. I'm just going to show you. This is construction permits of completions. The red line is the 10-year average. This is by quarter, but as he alluded to, we've seen a historic low of decrease in the number of construction permits and projects. The combination of rising construction costs, the high cost of capital, has made the financials unworkable. Additionally, we're addressing the lingering stigma that Portland is not an easy place to operate as a rental housing provider or developer, and that complicates the process of raising capital for new projects. So again, I talk to people, they're like, what do you mean we still see some cranes? For a project in Portland or anywhere really in Oregon to get going, it could be up to a 3-year process. From the time you start, getting the land, going through the process, getting approval. So what you see built now or getting completed now has been in the works for years. We're just not seeing anything new going in the pipeline. In terms of vacancy rates this last year, it remained relatively flat. We had some markets had some decreases. As we see people delaying family formations and also facing higher costs, as John alluded to, of not only purchasing but also maintaining single-family homes. Many are also staying in the apartment rental stage of their life longer. Additionally, we may see more baby boomers look to downsize into apartments, adding another layer of demand. So as we alluded to the flat immigration or even negative immigration is not great. The impact may not be as significant as in past cycles, thanks to the shifting demographics of people being in apartments and the unaffordability of single-family homes, combined with the lack of new supply will add to renter demand. In terms of rents, you can look at different things. There's Class A rents, there's Class B. We've seen rents have been relatively flat as we start burning off the concessions that were in this market, relevant as we had all the new construction that was coming up for lease up. As those have gone away, we've seen rents relatively flat. The projections moving forward are slight increases in the rents moving forward into next year. Depending on again, when you look at vacancy rates and rent growth, there's many different sources. You kind of have to look at, what it is. Certain ones only do Class A, some do only core, but we're seeing anywhere from CoStar is predicting, I think, pretty flat or 1.3, and so that's what we kind of predict to see next year. This one's not a great graph for me, but this is transactions. Number of transactions in 2024 actually went up 20% from 23, but 23 was a historic low. The run-up this year has been fueled by some larger transactions in the third and fourth quarters. But despite this growth, we're still historically way below where we were in 21 and 22. In the terms of dollar volume, this is number of transactions. In terms of dollar volume, the same thing. We've seen dollar volume has gone up by 40% this year compared to 23. But again, that's always fueled by the large institutional transactions, which we've seen coming back quicker than the private client. This also happened when we came out of the Great Recession. Institutional capital began transacting before we saw private clients coming back into the market. And we're seeing that same kind of pattern now. And again, so we'll see dollar volumes up in 24 compared to 23. It'd be hard to go below what we saw in 23. But again, we're still not anywhere near where we were in 21 and 22. Portland City Council, it may take a year or two for us to figure out how they're going to adapt. I think they're still trying to figure out how they're going to seat and where offices are going to be. So with this new structure, hopefully their focus is not on landlord-tenant law and maybe on trying to bring in new supply. They all talk a good game, but we'll see. There hasn't really been any legislation. There's been whispers of reducing the rent caps. But again, I don't know how much political momentum there is to do that in Salem. But in terms of the Oregon legislature, be prepared for change. There's a lot of new people in Salem, a lot of new leadership, a lot of new elected officials. The problem for our industry is they just throw a lot of things against the wall. You don't know if it's got legs on it. It's hard to get a sense of what's real and what's not real. But again, there's going to be we're trying to do a better job of educating the new legislators in terms of what the issues are, that we can't keep going against rental providers and developers. We need to talk, if they really are serious about supply, there's different ways to go about it. That's the hope. But again, there's a lot of new people in Salem. So it's going to be a little, we'll see what happens here coming up. We're having, I think, a day, multifamily's going down, I think, in February for a day in Salem. If anybody wants to go, they'll line up meetings with your representatives, and we can tell them their stories. It's much more impactful when they have people with living in their districts or working in their districts talking to them, as opposed to the same people bringing up the issues with housing. So that's something to think about, and we'll keep everybody informed if you can do that. In terms of prediction, I mean, rents I think are going to be flat or maybe slightly up due to what we just talked about before with the decrease in supply. Permits I think will continue to be down. I think vacancies will continue to trend down a little bit. Transactions will increase, hopefully, but I do think that with the increased capital flow into the Pacific Northwest, there's been a lot of capital on the sidelines. So I think you're going to see more of that. Employment and interest rates, if, kind of what John talked about, we're going to talk a little bit on that when we do the questions. I mean, our hope is that we start seeing some increase in employment. In terms of interest rates, if I knew what they were going to do, I wouldn't be up here. We hoped, we had this speech last year that we would see some kind of decrease in interest rates. Since September, when the Fed dropped 50, the 10-year yield's up about 100 basis points. We'll see what happens after, this new, administration gets in there, and if we see some more lenders coming in. But I'll leave it up to the economists to kind of what we think interest rates are going to do. So I'll introduce the panelists for people to know. We've got John Mitchell back with us. We also have Dr. Michael Wilkerson. He's a partner and director of economic research at ECONorthwest. We've had him speak here many times before. 20 years of experience in the public and private sector, and his unique experience at the intersection of real estate and economic development has a goal of creating effective policies, which we really hope so, producing outcomes that improve individual opportunities. I also have Charlie Kokernak, director at Gantry. He successfully closed over $2.5 billion in debt transactions across 400 transactions. This team maintains exclusive relationships with strong network of life insurance companies, as well as traditional capital sources, including local banks, credit unions, agencies, CMBS, and debt fund lenders. So I'll start with Charlie, just as we get in here. How are lenders and life insurance companies looking in terms of multifamily lending today compared to a year ago when we were here last year?
Sure. Is this working? There we go. Capital is available. Lenders want to make loans, but no one's doing funny math today. Properties are still sized based upon income in place, and as we've seen, there had been a decent amount of rent growth, but we are seeing rents top off. That is what's limiting lending still. The good news is that we are seeing more lender types come back into the market. CMBS lenders, if anyone's been through that process, it's not entirely fun. However, sometimes is the shoe that fits. Placed over $100 billion last year, which is another lending source that can create competition within the market. Lenders are still trying to backfill the void that was created by a number of banks that failed that did effectively have an outsized presence for their effective size. So the life insurance companies, for instance, some of them had their biggest year ever that we represent. One group placed over $3 billion in debt and is trying to do more this year. The key is going to lenders that can get their money out the door, that are not constrained by potentially requiring a depository relationship or potentially seeking a recourse guarantee. But the fact is the lending market is still fairly fragmented. So we are going to a number of doors and knocking on them. It's not like there is one source today, but it is absolutely restabilizing. And capital is available, but underwriting is still real. We are looking to income in place.
Okay. Mike, this is kind of the question regarding specifically kind of downtown Portland and its influence on the regional job market and housing demand. What you see as you kind of parse out some of the data that John had brought up, maybe shine some light on that.
Yeah, I mean, I think nobody likes inviting a skunk to a picnic, but I feel like I'm going to serve that role today, unfortunately, when you ask questions like that. I think, what role has downtown had? I think the best metric I can point to is ULI does a development opportunities ranking every year, and they look at the top 81 markets in the U.S. In 2017, Portland was number 3. Early pandemic, we dropped into the mid-50s. Then last year, we are 80th out of 81. And so other than Hartford as the least desired place, we're the next. And I think, with perceptions, I've heard some people say basically you drop like you're in an elevator and you take the stairs on the way back up. And so I think that's, emblematic of some of the challenges that are reflective of the perception of what's happening in our downtown. In terms of the economy, I think national economy is strong, statewide, generally doing great. If you look at the metro region, I think we have some unique challenges that aren't present in most other metros. And so you have Clark County, which is a rocket ship, and you have the Oregon side, which is dropping very quickly. If you look at the metro region, like John did, and you rank it in the top 50, so Oregon is middle of the road, the Portland metro region over the last year of the top 50 has bounced between 48th and the last month was 42nd. So we're about as bad as you can be from a performance standpoint. But if you look at Multnomah County versus Clark County, since 2019, Multnomah County is in the bottom 10th percentile of top 50 metros. You take 200 counties, Multnomah County is always in the bottom 20. Population growth and jobs, Clark County is in the top 20% in both of those. And so most metros kind of all move in the same direction, and here we have very different things going on. And it is true we added jobs, but the types of jobs we're adding, I think, would be the least kind of excited places that economists would see. There's 11 super sectors in the economy, okay? We only have growth happening in 2 of them, government jobs and private education and healthcare. Every other private sector industry, we are losing jobs in this region. And that's not good. If you look at office, for example, in downtown, we lost 6,000 to 7,000 office jobs in this region in the last year. And so, again, yes, nationally, I would say it's generally good. Oregon, pretty good. The metro in aggregate, pretty good. But when you peel it back and you start looking at what's happening in the city of Portland and our downtown, it's very challenged.
So back to Charlie, I mean, what's the lender sentiment towards, multifamily housing in, Portland proper compared to other regions? I mean, how do they also evaluate some of the policies that we have, rent control, rent caps? I mean, how do they look at that? Is that changed from where it was last year, or with this new data? What's your expectation?
Sure. Well, I think as Mike just said, you unfortunately are seeing employers not want to house themselves in Portland. If you looked at our latest measures that we voted upon, I mean, it looks like we're trying to kind of beat them away with a stick. So that is what's going to drive your wage growth and then translate into rent growth, which enables you to then go justify building. I will say very positively, our lenders love the fact that we have an urban growth boundary. Whether or not they directly acknowledge it, keeps land value high, keeps demand for the units that we do have. But we are in this perennial need for housing. I will say that the political profile of Portland is more challenging to lend into. If you are a larger, sophisticated institution and you can lend anywhere in the country, Portland is competing against funds, against projects in, for instance, the Sunbelt states that are growing quickly and maybe have less regulation. But the fact is there absolutely are merits as far as cost of living. I personally moved here about 4 years ago with my wife. We love the quality of life, frankly, outside of the city. But I think as you continue to see further pressures, as we move into the next cycle and the cycle thereafter, we will continue to feel those pressures from the higher rents and the higher cost of living in areas like Seattle and San Francisco. As we've seen, you can move with your job, but it's still a fairly challenging conversation to have. But I will say, in implementing a new and better direction with city government is a positive step.
Now, there does seem to be some positive news in terms of there's recognition that it's bad and that we need to make a change, and hopefully with the new council and a recognition of that we see some positive direction. John, this one was for you.
Can I make one comment? Yeah. One interesting thing about lending for commercial real estate, if you look at the senior loan officer survey that the Federal Reserve does, the standards for commercial real estate continue to tighten. And there's a lot of banks that have unrealized losses on their security portfolios because of that run-up in interest rates that we saw in 2022. And in the current environment, rates have not dropped the way people had anticipated. So those losses are still there. And I think that's going to influence the lending decisions.
So do you think there'll be less banks coming back into the market from a lending perspective to you two? I'll ask that. I mean, do you think you'll see regional banks coming back and getting capital out, or are we going to be still restricted on that?
Well, I mean, if you get some rate declines and those losses diminish, then I think there will be an appetite for more risk.
Yeah, I think compared to the GFC, where banks entirely exited or themselves failed, we just saw the spigot tighten in the last few years from banking lending. Instead of saying, no, we're not going to lend upon construction projects or stabilize commercial assets, we need some sort of credit enhancement. We either need to know that you as a borrower are providing a recourse guarantee or you're providing a depository relationship to kind of counterbalance and then bolster our own balance sheet. But I think the reality is, banks are fine, and if I had to guess, 25 will be the year where they pull back or stop the kind of extend and pretend type lending mentality of working with borrowers and say, okay, we now need to acknowledge what the future of this loan is. If it's not performing, we as a bank need to hold higher reserves against it for that perceived risk. What are you going to do? Are you going to be paying down that loan? Are you going to be refinancing? Are you going to be bringing in another partner? How can we restructure that?
Okay. Mike, this one's for you. Migration to the suburbs. Saw it during COVID. I mean, in your studies, what has that done towards the urban multifamily demand within the Pacific Northwest, not just Portland, but other markets? Are you seeing that decrease? Are you thinking that's going to come back over time? What's your kind of take on that?
Yeah, it's tough. I mean, I think early on, everywhere we saw the primary cities decline and the suburbs grow. That didn't last almost anywhere. You get into 23 and then 24, that's reverted to where big cities are growing again. So I think a lot of it is, generally speaking, that didn't happen. Portland is an exception there, where again, our city continues to decline in population while the rest of the region grows. But what I will say is population and households are very different. And so if you look at what's been built in the city, in the central city, we've had record deliveries over the past cycle. 80-ish% of that is studios and one bedrooms. And so population-wise, we are declining, but household demand is still high. And so what's happening is households or 2, 3, 4 bedroom demand are having to look elsewhere. And you see that growth into the suburbs. And so I think the development patterns that can support, let's say, lower densities with more bedroom counts or in places you can build single family is an option. But yeah, I mean, I think our regional development pattern is very different because of our urban growth boundaries and how we've prioritized density versus a lot of other places.
And then John, for you, you touched on this on your thing regarding inflation, wage growth affecting consumer confidence. Kind of talk a little bit about the renting versus buying housing that, you highlighted the affordability issue. I mean, do you think that's, mentally that we're going to have people in this longer period of renting versus the idea of trying to buy? Is it so unattainable? What's your take on that? Especially kind of on the West Coast.
I showed in the slides. I mean, a lot of people, they can't afford to buy. And so they're going to be in a rental situation. You've got a tight labor market, so they have earnings, they have income, and they have to have a place to live. But housing is basically unaffordable. And it's hard to see that changing in the short period of time. You could get significant declines perhaps in interest rates. I don't think that's likely. You could get big increases in supply. I don't think that's likely in the tight labor markets that we have. So I think this is a long-term issue. Now, one of the interesting things is it's getting attention everywhere. Okay. People are concerned about housing affordability, housing supply, what can be done to increase it. But it's a long-term issue. It's not a short-term. There's no short-term fix.
Yeah. Which, Charlie, I'd bring that to you then. What kind of challenges are developers facing in trying to get capital for projects? When you've had this pent-up demand, we see this wave coming. What are the challenges you're seeing in terms of trying to finance those or get those through?
Yeah, definitely scrutiny into budgets, rising costs and potential looming tariffs. Absolutely are being explored. One other aspect that I think is interesting is if you think about the time during COVID, I can't remember when underwriting deals another time when lenders asked so much, not just can you show me your rent roll, but what are your accounts receivable? How many of your tenants owe you money?
Right.
We are not necessarily seeing as much of a focus on that anymore, but the focus in underwriting, whether it's a new development or an existing project, is moving not below the line, but below your effective gross income. How are your expenses changing? Is your insurance going up? Do you have the right property manager? Are you bleeding money elsewhere for some aspect of your expenses? Because if, for instance, you have a rent-controlled property, and all of a sudden the expense load grows, it's not that 30 to 40% of EGI one would like to see. It can be significantly higher than that. And so lenders are digging into that. I don't know if we're going to talk about insurance at one point. It's kind of a topic in itself, but that alone can be double or triple the cost of what we blinked, and it was a different underwriting world overnight, it feels.
So I'll shine a little light on that. What we've seen is the number of people that are not paying, and we saw in COVID, that was a question from the lenders. How many people are on a payment plan or are behind? We're not seeing that number's gone down. What we are seeing is a smaller number of tenants that kind of know how to work the system. We're not getting a lot of support from the courts and some legislative stuff. So we've got larger balances. So we'd have percentage of people that are behind, but balances were all over the place. Now we've got a smaller group, really big balances that are really trying to work the system. So that's been a big issue we've seen in 24. The big concern that Charlie had brought up was on the expense side. Yes, we think rents may come up a little bit. The question are they going to outpace expenses? I'm sure everybody in this room has probably dealt with the insurance thing. What happened last week in California is not going to help. So just that component alone, but when you take that plus utilities, payroll, taxes, maintenance, I mean, the operational expenses have been quite a challenge to try to get a handle on. And then just locally here, it's tough to manage here. It's tough to manage in this market. As we've talked about, they don't make it real easy to be a rental housing provider or developer. And so there's costs associated with that. So that's been made things tough and makes trying to do a new project kind of unaffordable. So Mike, I'm going to bounce this one to you. There was a report that about office vacancies in downtown. You mentioned that. Beyond that recent announcement from the mayor that's saying he's going to bring a percentage of people back, have you observed any positive trends that help reserve this pattern? And then are there any local governments, do you think they're doing enough for this urban revitalization, or what's your take on what they're doing to try to, get this thing going back downtown?
Yeah, so, foot traffic continues to recover, but it's hitting a new normal. So last year, our central city, there were 8 million more trips in our central city than there were the year before. 2024, we had 3 million. So yes, it's growing, but that rate of growth is really slowing down to where the known levers that we had to pull aren't huge. Employment is a tiny fraction of that equation. The vast majority of our decreases are visitor foot traffic. And so it's people going downtown for retail, for events, for shopping, for food and beverage. That's the answer to our question, not can we get more people back into the office. Certainly more people back into the office helps.
Right.
I think local government right now is heading into a period of fiscal austerity that they haven't seen in a very long time. City and county both facing massive budget cuts, and you look out at the future and property tax revenues are anticipated to grow much less than the average cost of delivering service. And so historically, the city of Portland has expected 4% a year in property growth in the city. For their foreseeable future, they're anticipating that to be 2.5%. And I think 4% isn't enough to cover increasing expenses. And so I think the question is it reasonable to expect that local governments can burden that, or is this going to require state or federal interventions? Because I think the state is reluctantly starting to acknowledge that it's going to be difficult for the state to thrive when downtown Portland is struggling. And so understanding and acknowledging that, I think, opens up discussions around, yes, the cities need to get more creative and push the bounds, but realistically, they can't do it on their own.
So when you're looking, we were talking to public officials, I mean, are you, when comparing like our downtown to others or the recovery and what the timeline looks like, you compare to other urban centers that have maybe not to the Jurassic, I mean, what's kind of the message you're giving to them as they try to look forward in planning?
I mean, I wouldn't say we're very atypical. Yes, you could look at office vacancy rates might be slightly higher here. I think the difference is, again, the demand recovery here is much less than anywhere else. We're losing office sector jobs.
Right.
We already are losing construction sector jobs. And if you look at the top 50 metros, the kind of two things we track are construction and leisure and hospitality. So do you have demand within market? Do you have demand from out of market? Of the top 50 metros, Portland is dead last in both of those. So that's where I look at, foot traffic, yes, is recovering, office vacancy rate, but in the longer term and medium term, that's where we start to look at what's going to drive demand in the recovery here. I think our timelines are going to be extended massively for that reason alone, not necessarily, foot traffic as the current measure of that. So
then, John, do you expect, migration patterns that we saw when you compared Oregon to Washington with the challenge going on, I mean, what do you expect looking forward in terms of migration patterns, in the Northwest, Pacific Northwest moving forward?
Well, I think the events of last week might facilitate some movement or encourage some movement out of California. And Northwest would get part of that. One of the things I worry about Oregon is the income tax rates. You know, you look around at Texas, at Florida, Nevada, other places that have
Washington, 7 miles to the north. Yeah.
And look at the Clark County Portland thing. I think that's a problem for the state. We had a lot of migration, the early COVID stuff, people reshuffling, but now with the lock-in stuff and the aging of the population, the movement has slowed down in the national data. Now it remains to be seen how it's going to operate in the post-COVID environment as we move on.
So, Charlie, I'll throw this one at you. Kind of talk a little bit about the shifts maybe in, loan terms, prepayment penalties, things like that you've seen in the last, let's say, 12 months since the last time we kind of sat down.
Yeah, well, a big shift we saw third quarter or so of last year, the Fed started postulating that they would be dropping rates. Most longer-term debt products are based off of the commensurate treasury rate. So if you want a 5-year loan, lenders typically look to the 5-year treasury and give you some sort of spread above that. Treasuries dropped through the floor. They, rallied, you could call them. There was a huge rush to the exit. A huge part of the investment sector tried to refinance at the exact same time. There was a big glut of activity, and then that has since subsided when treasuries rose again. Now, I think that was the abnormal that we saw, that rallying of the bond market, and we are far more, as John was saying in his talk earlier, back to our new normal. But for some time when rates were lower, early 10s until, let's say, 22, people were fine locking up 10 years at 3-4%. Historically low. Now, we are certainly generationally high in rate, but at our historical averages today. So as, to answer your question, the change in lending that we have seen is most people are looking for 5-year money or 5-year money with some kind of prepayment penalty that is flexible. But we're starting to see lenders start to get full, and I wouldn't say tired of putting money into 5-year buckets, but when we see a borrower come along and say, I'm willing to fix for 10 years, we have more credence to go to a lender and have them give a more competitive spread and potentially even use a different index because they want to put out longer term funds so they don't have to just keep on recycling their capital over and over and over again. But it used to be just rate driven. No matter what, I can get to 75, maybe 80% of purchase as long as I'm not buying, an in-place 2 cap. Today it is part rate, but I would put that probably as focus number 4 or 5 in the actual, what is driving a loan request. And it's far more, can you get to the loan proceeds? Is this a lender who you want to be working with? Are you going to have, for instance, loan servicing issues if you have a lineage request to pass an asset on, for instance? But flexibility remains paramount. Our life companies, for instance, were typically known as yield maintenance only lenders, and they're absolutely starting to hear the market and have in the last few years opened up far more step down prepay options in order to meet that need.
And then are you expecting lending volumes to go up this year compared to last year, or is that the?
Yes, many lenders have larger allocations this year than last, and they want to put money out. Some are getting creative and, for instance, saying we're going to have a really low yield, low spread bucket for loan quotes for that business we really, really want to win. And maybe we're going to have a barbelled higher spread bucket for a little bit of a story. But there's no longer a what I would call vanilla loan request where it's, oh, I see something, I know exactly who that lender is. You are going to a field and saying, borrower, this is your door A, door B, door C kind of option. Do you want your porridge hot, cold, or lukewarm?
Right. I'll throw this to. I'm actually going to throw it to all three of you. So you're talking to a lot of multifamily investors. What would you recommend, like micro or macroeconomic indicators, that they should be watching closely this year as we're looking at that would trigger either, hey, we're moving in the right direction, we're not. What are the things in your world that I'll start with you, Mike, that you kind of pay attention to?
I mean, I think the number one thing is population, and jobs are intimately related. It's really hard to grow jobs when you're losing population. Our economy is already operating at historical levels of efficiency. Our jobs to population ratios are as high as they've been. Our unemployment rates are low. And so when you look at Portland as one of the few major cities that's still on the decline, I think, from the city perspective, that's crucial. I think we've all been talking about, starts aren't going anywhere soon. And so, as we start to absorb all those units, it'll be interesting to see how much rent starts to take off in various markets, as it's been generally pretty depressed everywhere.
Yeah. Charlie?
Oh, I think there's two things to look at. One on the larger economy that, we as an individual can't control, and then one on the actual asset side. With the economy, and John and Mike probably know more about this than I do, but we historically see about 100 to 120 basis point difference between where the Fed funds rate and where the 10-year Treasury is. So normally the federal funds rate is far below the Treasury rate. Right now, your federal funds rate is 4.25% to 4.5%, and your 10-year Treasury is pretty much right in line with that. So if anything, we are seeing pressures for rates to actually go up from here. And that's not to scare you and say, hey, you should refinance today, but that is to say that I don't think the Fed is coming to save us. That 250 to 300 basis point in drop that they indicated they might see as of 5 or 6 months ago, it looks like we are going to be only getting about half of that in the long run. So I would say start early. If you are looking at a refinance at some point in 25, for instance, there's no reason not to start looking to the market today. We obviously can chat, separately about ways to get in front of financing needs, but then the second I mentioned is your property level. That I had mentioned expenses are certainly going up. What will happen first? Would interest rates potentially go down a little bit, and that enables you to get a slightly better loan profile and slightly higher proceeds, or will your expenses increase, and whether or not interest rates change, you find yourself in the same position? Obviously, we try to keep expenses as low as possibly can, capitalizing items that are perceived as one time. But the realities are, from the larger economic perspective, job growth and wages are going to drive rents, and if rents are generally flat, but we have cost pressures on the expense side, you could find yourself generally at a net neutral.
Oh, just a quick follow-up. So if you've got a looming maturity date coming, how early are you recommending your clients to start talking? I mean, you can play the rate game but I think we've all tried to do that. But what are you telling people, 6 months, to start looking at, getting things in line for that if we know you have a, looming maturity date?
At the very, very least, 3 or 4 months. It's taking about 60 days to close from application. That said, we are going to many different market participants, which can take not days, but at times weeks, given there are, certainly less lenders involved in the lending space today. Back in 2022, we placed loans with 165 different capital sources. In 23, that was 96. Last year, that was 85. And we are intimately involved on a day-to-day basis, so we're just trying to offer reliability. If I had something coming in 25, I would be looking at it today and understanding, when, based upon the underwriting that I do have, would be the right time to pull the trigger, whether that's some sort of event, a partner needing to leave. I'm contemplating a sale, but I might refinance if I can't get to that, or I need to hit a certain rental rate in order to achieve the loan proceeds. Frankly, most refinances we look at, unless they were very low leverage to start, do have some cash in component.
Right.
As if you had what was previously a fairly moderate leverage request at 60%, size to our metrics from 21 or 2, those usually are full loan requests.
Okay. John, I'll throw that one question back to you. What indicators are you looking at, moving forward, you'd recommend people to kind of pay attention to?
Not to repeat what was said before, but I would be watching the GDP growth number, the inflation number, which will reflect some of the policies that might be put in place next week, because those will be, and the employment number will be input into the Fed's decision-making process, and I think the behavior of rates. I mean, so I'd be watching those things very, very closely.
Well, it's interesting. I had a discussion with an office broker a couple of weeks ago talking about the recovery and what's going to happen. And, their big thing was we've got to get, the kind of the it factor back to bring young, educated people back to Portland, and then the jobs will follow. And we kind of had a disagreement where I said that might have made sense, coming out in the early 2000s, where you had people coming up here without jobs, and then companies would come. I said, I think now it's a policy thing where we've got to get employment. We're competing with other metros, and I just don't see that demand of people coming up here thinking their jobs are going to follow. So I think it's imperative of us as an industry and a group to continue to put pressure on policymakers to talk about, we're just not going to get immigration without some kind of job creation and job growth, and the inequities between here, across the river, and in Salt Lake City, other markets. We still have a very viable place from the weather. The same reason people want to come here, it's still there. We just need to have opportunity, provide opportunity for people to come up here. And I think that's what we need to keep, reiterating to elected officials. I'll throw this one. We got a couple more minutes. I'll throw this to all three of you. As we look back, if we're sitting here at the end of 2025, what do you think the headline will be? Best case, worst case scenario, then what factors could determine the outcome? We won't record this part, so I won't hold it against you, but just curious. I'll start with you, John.
Best case,
Worst case scenario, we're sitting here at the end of 2025, and what would be the thing that may swing it one way or the other?
I would hope it would be economists said this would happen. If you put tariffs in place, the retaliation, it's a worst case, but and if we do that stuff, I worry. I'm worried a lot about that.
Best case?
Best case, that there's not a lot of reaction and we just keep on going. We're sitting here with an unemployment rate at 4.1%. Output has defied expectations, continued to grow at 2.5% to 3%, and it would keep on going. That'd be best case.
Charlie?
I think what's interesting is in the real estate world specifically, we have gone through a recession in the last few years, absolutely. The broader economy has been fine. Whether it was people getting $2,000 checks and going out and buying Xboxes, or operators who said, well, of course I'm going to be paying my staff, I'll take that PPP loan. But there has been a lot of cash in the system. That's on the economic front. We can certainly feel concerned about the real estate sector, but I think we have this recalibration that has been going on for the last few years. 25, I think, is going to be a jump ball, certainly. I don't necessarily think that on the political and larger geopolitical and perception of the United States on the worldscape basis, I don't think it will be as bad as some are fearing or as good as some are excited for. I think it will be, kind of like John said, a little bit more, hopefully, status quo. And I think that would be the best and the worst. If the question is, how much postulation will actually come to fruition, there certainly are some concerns. But at the end of the day, if that postulation does, my expectation is that would actually positively benefit the real estate economy specifically, but maybe the broader economy less so.
Right.
So it's kind of a, what could cause rates to go down? Probably a recession. I don't think anyone wants a recession. But then again, it's, do you win the battle and lose the war, or vice versa?
Yeah. Mike?
Yeah, I think they talked a lot about the national perspective, but I think it's not off the table that rates could go up. I think the Fed charted a path expecting many cuts last year and many more this year and many more the year after, and you're already seeing a lot of retrenchment there, and there's so much policy uncertainty that nobody knows. I think locally, if we were looking at best news, I think the CHIPS Act kind of bringing in dollars from outside of region to stimulate a sector that has been hammered over the last couple of years would be extraordinary news. I think seeing major employers stop leaving downtown would be a very good thing. But I think, for me, the worst case is kind of like this is on repeat and just more of the same, which is population declining, jobs declining, major employers leaving, our tax value proposition continuing to erode. So I think we have a lot of work to do on all those things.
I was trying to think of an analogy with where we are, and I was thinking, probably because my kids are 20, I was thinking it kind of seems like this region was kind of like a 20-year-old in the early 2000s, could do no wrong, could wake up in the morning after being out all night and go at it again. And now we've almost hit like a midlife crisis. Like, you can't do that anymore. You need to put things in place to, go through, and you're changing. And again, I'm not looking for, the exceptional growth that we had in the early 2000s, but just some moderate growth. But it feels like we're almost at an inflection point in terms of, It's getting national attention. It's happening in Salem. It's not just, locally we hear it. From a legislative side, they recognize the issue. The question, is there the political will to kind of move the needle in a substantial way and not just say, hey, we're going to support more food carts and that's going to bring people to Portland. It's a little bit more sophisticated than that. So my hope is that, in a good way, they recognize that and we start pushing that direction. So it's 1:15, which we're going to wrap up. So I want to thank the panel for taking the time to speak today. And thank you again, and really, thank you very much.